Hi folks, this is Ed Jameson, just getting set up. I've got about 1:45 here on the East Coast. We'll be getting started in about 15 minutes, but I just wanted to welcome you and look forward to the chat. Good afternoon, folks. Thanks for coming out and joining us today. My name is Ed Jameson. I'm going to be hopefully giving you some oversight on Defense Contract Audit Agency, DCAA compliant accounting system requirements for SBIR awards. So who is Jameson and Company? So I'm a 54-year-old man. I started this business when I was 14 years old. Obviously, there's a story behind that. So when I was in junior high school, I came home from school one day and my dad told me he'd lost his job and he was going to try to start his own business. And he said he wasn't sure how he was going to put food on the table. And I looked at my father and I said, geez, Dad, I really like to eat. So if there's anything I can do to help, let me know. So when I was 14 years old, he taught me how to reconcile bank statements. By the time I was 16, he had taught me how to prepare corporate tax returns. And by the time I was 18, I had a $40,000 book of business of canteen trucks, pizza shops, hair salons, kind of anything to make a buck, we did it. What I didn't realize was that my dad was a government contract accountant, and he had been with the Honeywell Electro-Optics division, and they had lost a huge government contract, and 300 people lost their job that day. And a number of them were scientists and engineers who started their own businesses as well, and my dad became sort of their part-time controller CFO. So in addition to learning how to prepare corporate tax returns, I was also learning how to prepare incurred cost submissions and how to deal with the Defense Contract Audit Agency. About 20 years ago, I bought my dad out. He's retired, lives on the Outer Banks in North Carolina. Smart man. And made our firm solely revolve around government contractor and grantee accounting. It's a niche that we really enjoy. We hire CPAs with 15 to 20 years of experience, and it takes them a couple of years before they understand all the acronyms that come out of our mouths. We have clients in 33 states. We deal with literally every federal government agency and every type of government award. SBIR and STTR are probably the two most common, but BAAs, BARDAs, ARPA-E awards, sort of you name it, you know, we deal with all of it. Our claim to fame is that we've helped our clients procure, manage, and survive audit on more than $4 billion in government contracts and grants. So what I'd like to talk about today is a couple of things. One, give you an overview of what it takes to have a compliant accounting system. Two, talk about the government audits that occur most commonly. There's going to be a lot of technical jargon, accounting jargon. I'm going to try to keep that to a minimum. But number three, if you can't answer these two questions when you go back to your business and you have government awards, you're in trouble. So I'm going to make it real easy for you. And then we're going to have a little Q&A time at the end if we have time. We try to solicit questions when people register. If it's really specific to you, I mean, I had some questions on like specific terms and conditions and how people should respond, and that's really tough for me to weave into an audience. Obviously, we're happy to have side conversations with people one-on-one. But if you have a question that you'd like me to address and you can throw it down in the chat window, I'm happy to try to weave it in during the talk or at the end. Obviously, the more people participate, it's tough to participate in a public environment, but the more people can participate, the more I know I've helped you. So that's really what we're trying to do here. So let's get started. So when I meet people and I tell them I'm a CPA, they immediately go, oh, you do tax returns. You must be really busy this time of year. Yes, I do corporate tax returns. It's not really our claim to fame. In fact, being an expert in the Internal Revenue Code is sort of like another language. I would equate it to, it's sort of analogous to Spanish. And when it comes to compliant accounting systems, it's irrelevant. It's its own language with its own outcome and has nothing to do really with government contract or grant accounting. Now, the fact that I became a CPA and prove to a board of accountancy that I was proficient in generally accepted accounting principles is very relevant. Think of that as analogous to the French language. It's part of our everyday requirement to maintain GAAP basis accounting records. So all of the underlying documents that you have to prepare in order to be compliant with the federal acquisition regulations, generally accepted accounting principles is an absolute requirement. What really makes our firm unique is we speak a special language. I'll say it's sort of analogous to Greek, just to go on with the foreign language analogies. But our CPAs are all expert in the federal acquisition regs and the cost accounting standards. And what really sort of tricks up our CPAs, even with 15, 20 years experience, is when they first understand and learn the federal acquisition regs and the cost accounting standards, a lot of them get tripped up. Our clients are dealing with the Department of Defense, Department of Energy, National Institutes of Health, and all of those agencies have the right to issue their own supplemental regs, and they do. So there are very big differences between what the NIH will reimburse you for and what the Department of Defense will reimburse you for. As an example, the maximum salary that you can reimburse yourself for in a DoD contract is about $500K, and with NIH it's about $200K. NIH will never reimburse you for your patent expenses. With the Department of Defense, they can, if you ask them and you do things properly. NIH will never reimburse you for your internal research and development costs, where the Department of Defense will. So there's a lot of big differences between the agencies, but what I'm going to try to do today is really just stick to the basics. So the first thing that you need to be able to do with your accounting system is you have to be able to segregate your costs as either a direct expense, an indirect expense, or an unallowable expense. A direct expense is an expense that if it weren't for this project, I wouldn't have had this expense, right? So it only benefits that one project. An indirect expense benefits all your projects. So as an example, rent. We have facility and all of our projects take place within this facility. We use telephones, we have electricity. Those are indirect expenses of running the business and can't be caused by any one particular project. An unallowable expense are expenses in the federal acquisition reg that the federal government just won't reimburse you for. So the fact that you and I went out to lunch and had a cocktail, the government doesn't get any benefit from alcoholic beverages, that's an unallowable expense. You'll see later on in the slides, there are travel per diem rates. So if you're going to travel here to the Boston area, you're probably going to stay in a low-cost area known as the Chelsea area, and you'll stay in something sort of equivalent to a Holiday Inn. You will not be staying in downtown Boston at the Four Seasons Hotel. That would be outside of the government's reimbursable rates. Now, you can stay at the Four Seasons, but the government will only reimburse you for the per diem amount in that area. So effectively, they'll reimburse you to stay at the Holiday Inn in Chelsea. So let's just go through a few of these expenses just to make sure that we're on the same page. So the first one in my bullet list, expenses not in the original proposal. So I talk to people all the time. I give talks all over the place, and people are frequently asking me, but I didn't put this in my budget. And I will tell you, we've had thousands of clients winning thousands of awards over 4 decades, and I have dealt with some of the most brilliant people on the planet, and none of them was actually brilliant enough to foresee exactly how a project that was going to take place in 6 months was actually going to spend out. So it's not normal for you to be able to project exactly how a proposal or how a project is going to run, and the government doesn't expect you to. So one of the things that occurs in most of these awards is that you have, with NIH, they're called SNAP provisions, but effectively you have the right to rebudget between the categories as long as you're not sort of rescoping the entire project or spending in excess of 25% of the entire budget. So if you've got a $1 million phase 2 award, you'd have to rebudget more than $250,000 of that award before you have to get the government's permission. Now, the one caveat that I will make sure that you understand here is you can rebudget between direct categories, direct labor to direct materials. I was going to subcontract something, but I decided to do it in-house and do it as direct labor. we were going to hire a consultant, but we decided to do the work ourselves. That's perfectly fine. However, if you don't negotiate an indirect rate, you cannot rebudget costs from a direct category to an indirect category. So that's a really big distinction that you need to understand. One of the other things that's important to note, and I'm not really sure why it's not in one of my intro slides, maybe it's out of order, but all of these requirements come about because of FAR Clause 52.216-7, and I won't do that to you anymore, I promise. But FAR Clause 52.216-7 is the allowable cost clause, and effectively what that clause means is that you have a cost reimbursable type award. So the government really does business three different ways. Fixed price, if you deliver me a pen, I'll give you 39 cents. Time and materials, I'll give you $50 an hour to dig a hole. And then the other one is, geez, I'd really like you to cure skin cancer. We're not really sure what the technical spec is to get that done, so we'll reimburse you for your allowable costs. That's really the sort of thing we're talking about. These tend to be in R&D contracts and in projects where the scope is really difficult to spell out in an award. So all NIH awards, Phase 1 and Phase 2 SBIR awards, will be cost reimbursable awards. With the Department of Defense, Army, Navy, Air Force, Department of Homeland Security, typically Phase 1 is a fixed price award. Typically Phase 2 is a cost reimbursable award. With contracts, it's fairly easy to figure out if it's a cost reimbursable award or not, because there'll be, maybe it's a 35-page award and there'll be a couple of pages of FAR clauses, and you can literally just go down through the list and you go, oh, 52.216-7, there it is. It's a cost reimbursable type award. With NIH, you may get a 3 or 4 page notice of grant award, and in there is a hyperlink to the NIH grants policy statement, and when you click on that hyperlink, it literally takes you into thousands of pages of regulations, and each page seems to have 10 or 15 hyperlinks in it, and it literally just takes you into a myriad of tens of thousands of pages of regulations, and at some point most people just give up and sort of start the technical work, and we'll talk about some of the repercussions of that later on. So to get back to our thought process about direct, indirect, or unallowable expenses, though, I did a talk for the Principal Investigators Association a while ago, and I got a follow-up call from one of the participants, and he said, Ed, is a lab jacket is it a direct or an indirect expense? And so I sort of thought to myself, well, geez, a lab jacket is something that you wear during the day that protects your clothes from all the projects you work on. So my sort of mind was defaulting to indirect. And again, I have a lot of smart clients, so I don't usually just, go without asking a question. So I said to him, why do you ask? And he said, well, we do this one particular bovine experiment, and when we slaughter the cattle, it destroys our lab jackets. And I said, oh, in your particular case, that lab jacket is a direct expense. So one of the things that you need to understand is unallowable expenses are specifically unallowable. So alcohol is always unallowable. But whether something is direct or indirect is really case dependent. It depends on your business. So in this person's case, a lab jacket was a direct expense, because if it weren't for that project, he wouldn't continuously have to replenish his lab jackets. For most of my clients, a lab jacket is an indirect expense. Medical and dental insurance, paid time off. The government has something known as the Service Contracts Act that makes them very aware of almost every labor occupation in the United States and what a normal person within those ranges makes. The DCAA has a database of sort of reasonable salaries for every kind of occupation imaginable. So when it comes to benefits, medical and dental insurance, paid time off, it's very much a function of where in the country you are. So as an example, if you're in Silicon Valley, you're competing for employers with Google, who drives a bus to somebody's house, picks them up, drives them to work, feeds them, takes care of their dry cleaning, and then drives them home. So if you don't have a competitive medical, dental, and paid time off policy in Silicon Valley, you're not going to be able to hire an employee. I don't know that you're going to be able to give as rich a benefits package to somebody in Ames, Iowa. And I don't have anything against Ames, Iowa. I'm just saying I don't think that Google's there driving their employees to and from work yet. So you have to use this concept of reasonableness, and reasonableness on the coasts and reasonableness in the center of the country and reasonableness down south mean different things to different DCAA and different government agencies. I get asked all the time about bonuses, and the thing with bonuses is why are you giving the bonus? So if you're giving the bonus because you sat down with somebody at the beginning of the year and you said, hey, I'd like to incentivize you, and if you can do A, B, and C, I will give you a bonus. And at the end of the year, you sit down and you measure them against A, B, and C, and as a result of that measurement, you give them a bonus. That's a perfectly allowable expense. If at the end of the year you discover that you're underrunning your indirect rates and you decide to give yourself a bonus, that's not okay. So an incentive bonus needs to be documented thoroughly, and one of the things that the government auditors look for is everybody participating in this, or is it only the owner of the business? Because the more everybody participates and the more well documented it is, the more they're going to be okay with it. Telephone expenses, obvious, no-brainer, of course it's allowable. Rent, of course it's allowable. Now, we have clients who own their own facilities because, you know, they have special, special needs, and they go to landlords, and the landlord said, hey, we can't retrofit a building with all of these specifications. So one of the basic thoughts here is that you are doing business at an arm's length with your vendors. So if your landlord isn't related to you, then the government knows that the landlord's looking out for his economic interest and you're looking out for your economic interest, and as a result, the transaction is fair. If you're renting from yourself, the government will go through a formula and effectively try to figure out what the economic substantiation for that transaction really is. One of my favorite questions is, are accountants and lawyers' costs allowable? I will tell you that accounting fees are all allowable unless I'm doing your personal tax return, which has no value to the business. So there's literally nothing that I could do that wouldn't be reimbursable by the government. With a lawyer, it depends. So as an example, if a lawyer helps you draft an employee handbook, well, that's good business practice. That's allowable. That's an indirect expense. If a lawyer helps you get an H-1B visa, that's an allowable expense. There's a benefit back to the government. If a lawyer helps you raise Series A financing and charges you $40,000, all you've effectively done is transfer a part ownership of the company from yourself to somebody else, and the government didn't get any economic benefit from that. So those legal fees would be unallowable. So some of these are fairly straightforward. Some of them, there's a reasonableness component. It's always a case-by-case component. And in some of them, you really have to just kind of understand that the answer is nuanced. So one of the things that the government is keenly aware of is one of the largest components of expense in most of their contractor and grantees general ledgers is labor costs. And the ability for people to manipulate labor costs has been going on for years, and the government is very keen to it. So there is a required timekeeping policy that you have to have, and this is literally what it says in the government regulations. It says an employee has to fill out their time card in ink on a daily basis. The employee must record all time, and they have to sign off on the time card. The supervisor has to sign the time card, and all changes have to be crossed out and initialized. Now, this will inevitably beg the question, is it okay for me to have an electronic timekeeping system? The answer to that question is, as long as your electronic timekeeping system does these things, it effectively needs to create a forensic audit trail. But as long as it does these things, it's okay. Now, the issue becomes, just because you bought T-Sheets or Nexonia or Uninet does not necessarily mean you have an acceptable timekeeping policy. You have to maintain on an ongoing basis all of the things that I'm talking about. So I had a client come in the door from Johns Hopkins. He was a Johns Hopkins professor, and he had started his own company. And, you know, he was sitting there saying to me, you know, I have an acceptable timekeeping system. I have T-sheets. And I said, you know, Dr. X, you haven't filled out a timesheet in over a year, and you pay yourself. This is an ongoing discipline. This isn't a one-time thing. You can't shrink wrap the solution to these problems. You're not maintaining an acceptable accounting system. So it's really important to understand that this is an ongoing discipline. Now, another labor policy that you're required to have is you have to tell the government how you're going to account for uncompensated overtime. Now, so whenever I say this to people, they immediately go, well, what the heck is uncompensated overtime? So let's take as an example, you hire a new employee and you're going to pay them on salary as opposed to hourly. So you're going to pay them $80,000 a year. And I know there's either 2,080 or 2,088 hours in a fiscal year, but to make the math easy, let's pretend there's 2,000 hours in a year. So you're effectively going to pay this person $40 an hour. Now, this person is going to work during the month of January. Let's say he spends 10 hours on project A, and you're going to bill 10 hours at $40 an hour. So you're going to bill the government $400 plus overhead, G&A fee, whatever else is in there, and you'll get reimbursed by the government. But let's pretend that at the end of the year, this guy's kind of a workhorse, and he's actually charged 2,500 hours in total on his timesheets. Well, you did all of your math based on a 2,000-hour year, and remember, this is a cost reimbursable type award. So if you pay him $80,000 and he works 2,500 hours, that actually turns out to be $32 an hour. And you've effectively overbilled the government by $8 an hour. Now, I'm here to tell you, if you underbill the government, they won't say anything. There's this implicit thank you. If you overbill the government, they will stick their hand out as quickly as you can imagine and say, we expect to be reimbursed. So the most common cures for uncompensated overtime are, one, pay for overtime. Now, most of our clients are bootstrapped, so they don't pay for overtime. Second one, change the billing rate every month. So depending, $80,000, and let's pretend that this guy gets paid monthly, turns out to be $6,666.66 a month, and you simply divide by the number of hours that person charged that month, and you come up with a different billing rate every month. If you have 2 or 3 or 4 employees, probably fine if you're using a manual timesheet. But if you've got 20 employees and you're going to change the billing rate every month, gosh, I hope you've got an electronic timesheet, because the chances of you messing up the math at some point, retroactive pay raises, whatever, a lot of propensity to make an error there. The last common cure, and there are several others, but the last common cure is to credit the government for the overbilling to the indirect rate pool. So you would effectively take the $8 an hour and you would charge that variance back as a credit to the overhead rate pool. So if your indirect rates were running at, say, 130% and you credited back the overbilling, then maybe the indirect rate goes down to 115 or 120%. Now, I've been speaking at the National SBIR conference for years, and it's at this point where people usually who are sitting together start whispering to one another. And effectively what they're saying is, hey, let's just charge 40 hours a week on our timesheet so we don't have this kind of problem. And this is where you start to get into trouble. So when you do business with the federal government, you're dealing with a multi-trillion-dollar customer, and there are hotlines for wronged employees to call and things of that nature. So I'll tell you a quick story about the MIT professor, and this is a sad but true story. Years ago, and I mean decades ago, I had a client in the next town over, and he was a tenured professor at MIT. He had spun some technology out of MIT through the tech transfer office and had about 25 employees. He was a brilliant man. The technology he was working on was fascinating. He was just the kindest, gentlest man I'd ever met. He was always very sweet to sort of show me around and explain what was going on from a technical perspective, so that when I looked at the books, it made more sense to me so I could be more helpful to him. And his wife was the chief financial officer, and she was loud and abrasive, obnoxious, nonstop talker. You know, I got to be honest, I would go over there for a couple of hours, and it was about all I could deal with. And I would drive home, and I would just think to myself, I wonder how those two get along. Well, I guess one day the MIT professor asked his wife for a divorce, and the next day DCAA came knocking, surprise floor check. And the auditor went around, and they had 5 employees that they wanted to interview, and this is the government's right. And they effectively got to the first employee they got to, what are you, and I'll make the long story short. He basically asked this PhD what he was working on. And the PhD effectively answered, I'm working on this commercial technology. And the auditor asked him, where was his timesheet? And he pulled out his timesheet, and he was charging all of his time to a cost reimbursable phase 2 SBIR award. And the auditor asked him, why are you working on this commercial technology and charging your time to this other project? And he said, now this was back in the day when interoffice mail used to come in those big envelopes with the holes in it. And he pulled out a memo from the CEO, the MIT professor, that said to the employee, please charge all of your time to this contract until it's out of money, regardless of what you're working on. And the auditor's jaw almost fell off his face. He went back to his office and stopped the company's ability to progress bill the government, and they were effectively blackballed in the federal government. And that MIT professor is now happily divorced, and he works for his research assistant, who now owns the company. So there's going to be a few slides like this in the presentation. I'm, a little fear-mongering, but unfortunately, they're all true stories. So let's talk a little bit about the documentation that you have to have for some of your other direct costs. So for consultants, you're required to have a consulting agreement with an hourly rate and a detail of the scope of the work to be done. And the consultant has to provide you with an invoice detailing the amount of hours they worked and the details of the work performed. When it comes to subcontractors, it's really the same thing, but taken to another level. You're required to have a signed subcontract agreement, and if you have certain requirements in your award, you must flow down all of the same provisions that you're subject to your subcontractor. And this is, we actually do some public accounting. We audit grantees who are required to have a uniform guidance audit if they, don't hire us as their inside person. And one of the biggest and most common findings we have are people do not monitor their subcontractors properly. And I got to be honest with you, it's probably very difficult to control Harvard University or Johns Hopkins or any of these places, but it's your obligation. I spoke a little bit earlier about travel and the government. They have published per diem rates depending on where in the country you're traveling. The rates are different. They're higher in San Francisco than they are in Ames, Iowa. And when it comes to materials, you have to vouch your expenses. So an expense comes in and it should be clearly marked as a direct and indirect or an unallowable expense. And if it's a direct expense, which project did it go to? And all of the supporting documentation needs to be lined up with that voucher document. And again, this is a little fear-mongering, but it's true. Northwestern University several years ago paid a $3 million fine. The thing that I really want to point out to you here is the reason that you have to be so careful in the way that you document things and the way that you communicate with your employees. The whistleblower provisions provide anywhere from a 15 to a 30% of the damages recovered go to the whistleblower. So in this particular case, Melissa Theis, who was a purchasing coordinator, who noticed some irregularities, wound up with a $498,100 settlement check for blowing the whistle. So let's talk about how you're going to be audited. So there's very different mechanisms for being audited, whether you're a Department of Defense contractor or you're an NIH or a DOE grantee. So if you're an NIH or a DOE grantee, you can take a nap for a couple of minutes. For the next 5 minutes or so, I'm going to talk about the different types of audits for Department of Defense contracts. So The most common types of audits that we see are accounting system reviews. Now, when you're going from a phase 1 SBIR award to a phase 2 award, typically phase 1 is fixed price and typically phase 2 is a cost reimbursable award. And before you get that, $1.5 million phase 2 award, Defense Contract Audit Agency is going to come out and do a pre-award audit. You have to demonstrate to them that your accounting system is set up and functioning properly, or you won't get the award. Now, when they do a post-award audit, when the award is over, this is a much more difficult audit to pass. So, a pre-award audit may take a couple of hours. A post-award audit takes a couple of days. It is an incredibly thorough audit, and is probably it should be the highest on your fear factor. We've talked about surprise floor checks. Once a year, you're required to submit a provisional or temporary indirect rate submission to the government. So, our overhead rate is 120%, for 2018. You submit the documents to the government. DCAA looks at it to make sure that they believe that the indirect rates that you are proposing on your projects and billing the government are reasonable. The government is now doing random voucher audits. So when you bill the government, they will once a year, they're sort of randomly picking, hey, you've sent us a bill for $38,725.45. Where did all of these expenses come from? We're going to talk about this one a little bit more. I think we've got a slide for this later on. And then when you have a cost reimbursable award, you have to prepare something called an incurred cost submission or a rate package. It's effectively a true-up report. But what's happening is when you write your cost type proposal, you project an indirect rate. Let's say you project an indirect rate of 120%. The auditor comes out during the pre-award and says, yes, this 120% indirect rate appears to be reasonable. You do a month's worth of work, you bill it 120%, you do another month's worth of work, you bill it another 120%. The year goes on and on and on. When you get to the end of the year, you're required to prepare this incurred cost submission. Now, if your actual indirect rate comes out to 115% and you've been billing the government at 120, you've overbilled the government, and the government says, I'd like my 5% overbilling back. And the next bill you submit to the government, you have to credit them for the amount that you've overbilled them. If you've underbilled them, you have the right to charge them. But remember, you're dealing with a political process. So if I told you I was going to do your personal tax return for $50 an hour as long as I could control my overhead rate, and then in reality I couldn't control my overhead rate and I charged you an extra $25 an hour, you'd probably be pretty happy and you probably wouldn't do business with me again. So it's really important that you do a good job of projecting your indirect rate properly, and that you monitor your indirect rates as the business goes through its normal business cycles on a monthly basis. We've actually written a white paper on understanding the different types of DCAA audits. If you go to jamesоncpa.com, there's a resources section. You'll see white papers. There's actually recorded webinars of helping you better understand indirect rates, but you might find those of some value. Now, when we're talking about Department of Defense contract audits, these audits are always performed by the Defense Contract Audit Agency. There's about 4,500 auditors, and there's 300 branch offices all over the country. DCAA does not get paid by you. They get paid by the cognizant government agency. So if you're doing business with the Department of Defense and the National Institutes of Health and NSF, whoever your biggest customer is effectively your cognizant government agency. And that agency pays for DCAA to come out and audit you, and they are required to share their information with the other government agencies. Now, obviously, a surprise floor check always occurs at your facility, but an incurred cost submission and an accounting system audit occurs where your accounting records are located. So a lot of our clients, one of the big appeals is they outsource their accounting to us. The auditors show up here. If the auditor wants to tour your facility, we hop on a plane and we walk around the facility with the auditor, but we sort of control the process where our clients sort of choose that way of working with us. I'm going to talk a little bit about government billing audits in a minute, but I want to talk a little bit about incurred cost audits first. So again, you've got a cost reimbursable award, you're billing the government at 120%. At the end of the year, you are required to submit this true-up report 6 months after your fiscal year ends. The auditors are looking at these documents, and they would love to keep you in a low-risk audit profile, because low-risk audits are done as desk audits. So they basically go through and do analytical reviews, ask you a bunch of questions through email, and it's much less intimidating. If you have failed a voucher audit, a floor check audit, if they've got some skepticism during a pre-award audit, you will not be placed in the low-risk pool, and they will do an in-person audit. So, and if you stay in the low-risk pool for several years, you get cycled in. So the goal here is to have a low-risk audit, to make sure that you don't have any audit findings, and to then only cycle through for these full-blown accounting system review audits on an occasional basis. So it's much more risk-based now, and effectively what that means is as long as you stay clean, they try not to come out and bug you. But if you show yourselves to be a problem, they show up a lot. So one of the audits that you will not get away from anymore is DCAA has a new progress billing audit. And these are effectively little mini accounting system audits. So even if you stay in the low-risk pool, once a year, DCAA is going to select an invoice. So you bill the government $37,425.75, and they're going to come out to your office and say, okay, show me the substantiation for this bill. And they will literally look at timesheets. They will tie the timesheets to payroll journals. They will tie the payroll journals to labor distributions. They will tie the labor distributions to job cost reports, and they will, again, charge them right back to proof that the employee was actually paid. Not only that, but they will interview some of your employees to make sure that they were working on those projects. So it's really this little, fairly intimidating mini accounting system audit where they're almost taking all of the audits that I've been talking about and just kind of making sure that you are maintaining the accounting system that you told them that you would. Hopefully that makes sense to you. And if you keep yourself clean, you tend to stay in that low-risk pool. And if you have problems with anything during these processes, you get put into the high-risk pool. And again, what can go wrong? These are all, the slides are all available if you want to do some research afterwards, but there were 2 University of Houston professors who were indicted and convicted. They actually served some jail time. And I think one of them paid a $100,000 fine. They had a company called Integrated Microsensors. You can see they were receiving SBIR awards from NASA, NSF, Department of Energy, and the Air Force. Not something to take lightly. Let's shift a little bit now to grants. So if you're a contractor, you can go take a little 5-minute break. And if you're a grantee, welcome back. It's time to pay attention. So grant audits are very different from contract audits. So with contract audits, the government pays DCAA to come out and audit you. With grants, there's this theory of grantsmanship where you are expected to conduct yourself in a certain manner. And when you go through the pre-award process, there's not much scrutiny. So I'm going to give you an example. Let's say that you're an NIH grantee and you're about to get a Phase 2 award. The grant specialist will effectively ask you for a copy of your chart of accounts and a copy of your timesheet. Now, I got to be honest with you. You can go right to NIH's website and download their sample chart of accounts and their sample timesheet and give it right back to them, and the grant specialist will rubber stamp you and say you have an acceptable accounting system. If you have more than $750,000 a year in revenue earned from a grant, you are required to go out and hire an outside CPA firm to audit your accounting records to make sure that they are in compliance with the federal acquisition regs. So this used to be called an OMBA 133 audit. It's now called the Uniform Guidance Audit. And this applies to, typically applies to grants and cooperative agreements with NIH, Department of Energy. And the other type of audit that you will see is if you project an indirect rate in your proposal that is less than 40%, you will not have to negotiate an indirect rate. You will not have to prepare an incurred cost submission. However, I see so many clients and so many of our new clients come in and they are hemorrhaging money because it is very difficult to run a business with an indirect rate of less than 40%. But they're so afraid of being audited that they ask for a 5 and a 10 and a 20% indirect rate, and they're literally hemorrhaging money because they're running at a much higher rate. So if you request a rate more than 40%, you're required to prepare an incurred cost submission, which gets audited by the Division of Financial Advisory Services down in Bethesda, Maryland. It's a desk audit, so they don't show up in person. And I'm going to talk a little bit about, it's sort of an epidemic. We call it inadvertent fraud. Now, I'm going to talk about it in a minute, but if you want to understand more about the strings attached to your grant, again, we've written a white paper that I would encourage you to download. Again, it's on our website. If you go to jamesoncpa.com and go to resources, you'll see them. So that sort of brings me to a topic that's near and dear to my heart. I hear people all the time using these safe rates. Now, with NSF, they use 50% of direct labor costs as their safe rate. But what I really want to talk about is NIH, because I see a lot of people getting into a lot of trouble with NIH. And with NIH, the safe rate is 40% of all direct costs. So people will take a 40% rate, even though maybe they're still in an incubator or, you know, they haven't really sprung out. I do a talk on indirect rates, and there's a point when your project turns into a business where these safe rates are really just not going to be adequate to reimburse you for your actual costs. And I see people make two huge mistakes. One is they'll ask for a 40% indirect rate when they're in an incubator and 40% is too high, or they'll ask for 40% when they're running a business and it's just way too low and they're hemorrhaging money. There's another option, though, which is called, I think I'll commit inadvertent fraud. And this is where, grantsmanship is almost a comedy because it pretends that you understand all the rules, which, you know, when I'm driving you into tens of thousands of pages of regulations, not every person is going to spend every minute of every day reading government regulations. So I fear that the system is sort of set up to trap you. But let's talk about how to commit inadvertent fraud for a second. So let's pretend that you ask for an indirect rate of 35% with NIH. So because you didn't ask for a rate more than 40%, the Division of Financial Advisory Service never actually looks at your accounting system to make sure that it's really okay. The NIH grant specialist performs a cursory accounting system review. So you're walking down, you know, thinking you're okay when in fact you're not. You start drawing down money from the payment management system. So with Department of Defense, you do a month's worth of work, you submit a bill, and you wait to get paid. With NIH, they put your money into a cloud known as the payment management system, and you literally have a user login name and a password, and you say, I'd like $37,425, and you push a button and it shows up in your bank account the next day. I mean, it's magical. But then there's this trigger, which is known as a federal financial report or standard form 425. And what happens is, remember I said earlier on, if you don't negotiate an indirect rate, your indirect rates are capped at whatever you propose. So if you proposed a 20% indirect rate, and your rates run higher than that, your rate is capped at 20%. And remember I told you, you can't rebudget from a direct to an indirect category. So if you have this mindset of all of these expenses that we have appear to be valid, so I'm just going to draw down what we need to pay the bills, which is what most people do, you wind up in trouble because your actual overhead rate is running at higher than whatever you're supposed to be billing the government. On the flip side of it, people who are sitting in incubators running at a 20% indirect rate and are billing at 40% because they're entitled to are in the same kind of conundrum. Then what happens is it's on a quarterly basis, you're given this standard form 425, and I have to be honest with you, I have CPAs with 20 years of experience who are filling these out for clients, and the first few times they fill them out, they're down in my office going, is this right? Did I get it right? Do I check budgeted or actual? Did I, you know, like, these are CPAs with 20 years of experience, right? And if you don't maintain your project cost accounting records properly and you don't maintain your indirect rates, properly. Line 13, by signing this report, I certify that it is true, complete, and accurate to the best of my knowledge. I am aware that any false, fictitious, or fraudulent information may subject me to criminal or administrative penalties. And guess what happens? This is a fairly recent case. Washington State University professor may face up to 30 years in prison. This is a company right down the street from us here in Woburn that was rated. I mean, these guys were like on the Inc. top 500 fastest growing companies, right? They were rated by the FBI, and here we go. The company directed and allowed employees to charge hours that did not correspond with the actual time and effort on awards. Additionally, employees were given written instructions on how to change the timesheets and how to destroy the documents. The company and its president agreed to pay a $2.25 million fine to resolve the allegations. This is not something to screw around with, folks. So when should you be really concerned? When you prepare, or your accountant prepares a bill to the government, the information to bill the government should come from a job cost report. A job cost report should look just like the proposal you sent to the government. Direct labor, direct materials, direct consultants, plus overhead at the projected or budgeted or provisional rate, plus the fee. Here's the total bill to the government, right? Then let's assume that the overhead rate that you're using is 120%. You ask your accountant, how's the actual indirect rate running? When you ask them, how's our actual indirect rate running, they should give you an answer very quickly, like 110%, 130%. It should be a number. It shouldn't be a story. It shouldn't be on a napkin. It should come out of your accounting system. So if you're billing the government at 120% and they're saying something that's within a 20% range in either direction, you can probably be sure that you're okay. When I ask, so people ask me all the time, am I okay? And I just knee-jerk reaction, I say to them, do you know what your overhead rate's running right now? And I can't, like I have to tell you, 80% of the people I talk to can't tell me what their indirect rates are actually running. And I look at them and I say, how could you possibly have an acceptable accounting system? You're required to track your project costs and bill the government based on this provisional or budgeted rate, and then monitor your actual indirect rates in accordance with the federal acquisition regs. So you have to do a good job of project cost accounting, and you have to monitor your overhead rates. So if you can't get these two questions right, you've got trouble. So how do we help supplement your financial team? We can help you with your indirect cost rate development. So when you're writing a proposal, it's an important time to make sure that you get the budget right. So we can help you. We have templates and projections, and it's a relatively simple process. We can help you with the financial negotiations with government officials. If you get to JIT with NIH, if you get to the point where you're sort of getting the wink and the nod from the Department of Defense and they want to go through the pre-award audit process, we can help with all the financial negotiations. You can literally outsource the entire thing to us if you want. We can help you set up your accounting system, give you training and periodic oversight. We can prepare the annual incurred cost submission and represent you during government audits. So we can be as involved or as uninvolved as you want us to be. And most of our clients will sort of, when they're smaller, they'll go through what we call a phase 1 survival kit because they want to understand how this works a little bit better as it pertains to their business. But then they very quickly realize, I didn't go to MIT or Cal Poly to spend my day doing accounting. So they will bring in maybe a bookkeeper or an administrative person to interface with us, and we will take care of the financial piece so that they can take care of actually building the business. So when's it the right time to call Jameson & Company? So when you're filling out the cost portion of your proposal and you're not really sure what the heck to put in there, if you're not realizing, I hate to say it, but these SBIR awards, you should be realizing a 7% profit on your grants and contracts. If you write in the proposal 7%, the government rubber stamps it and gives it to you. If you're not getting those kinds of profits, it's probably because you're not managing your indirect rates properly. So when you're not managing your indirect rates properly, you're probably also having cash flow problems. Maybe you're taking on unexpected debt, whether it's credit card debt, lines of credit at the bank, borrowing money from relatives. or you're, diluting yourself, whether it's through Series A financing or whatever it might be. If you're having problems getting paid by the government, the WAWF process, the wide area workflow process for contractors can be a little bit intimidating. If you're an NIH or a Department of Energy grantee and you've got to fill out one of these SF-425s and you're not sure that you know what you're doing, or if you've just got some basic concerns about your existing financial team, we're here to help. So, I mean, we can plug ourselves in at any sort of level. For joining us today at our webinar, we've got a couple of specials I want to make you aware of. So these are introductory products. If you're a new Phase 1 award winner, we've got something called the Phase 1 Survival Kit, which we usually sell for $2,250, but we offer it for $1,995. So what we will do is set you up with a FAR-compliant accounting system and give you some training on what you need to do to keep yourself out of trouble, and it's really geared towards you personally, your business. Included in the Phase 1 Survival Kit is an indirect rate projection and cost proposal support, which you can purchase separately. So when it comes time to do a cost proposal for a cost reimbursable type award, we will send you the right indirect rate projection template and work with you to make sure that you propose the right indirect rate for your business. If you're interested in either of these intro products, please reach out to Ryan Remington at Jameson. He's at extension 2106, or you can reach him at ryan@jamesoncpa.com. So I think that's all I've got for today. I've got a couple of minutes. I can take questions. If anybody wants to raise their hand, I'll unmute them and we'll see if we get any questions. So let's see if anybody's got their hand up. All right, I've got Tom. Tom, are you there?
I'm there, but can you hear me? It looks like I'm still muted.
No, I've unmuted you. Can you hear me?
Oh, yeah, I hear you well. Thank you.
Great. How can I help?
I submitted 3 written questions during your talk. And so I just want to quickly hit on the most relevant ones,
Okay.
which is your comments about the lab code and direct versus indirect. We had a situation in which we had a cost plus contract. We were still under it, in which it's a classified contract. In the course of that execution of that contract, it's the only classified contract, and we went through and we got our, using indirect costs, set up our security information and et cetera, and became certified with the classified facility. But during the course of this contract, which was the only classified contract we had, there was a security breach. We reported it, and then there was a cleanup of that security breach, which was a large amount of money, like $50,000. So to me, this breach, the cleanup of the breach, was caused by this contract and could be direct. Of course, the contracting officer for the contract disagrees and says, no, that's the course of business. So what's your take on that?
Well, Tom, I will tell you, I saw that question and I didn't think it was appropriate for the audience because it's going to be, this is a very political situation that you're in. So theoretically speaking, if it weren't for the classified contract, you wouldn't have had security costs and had to deal with the security breach. The real problem here is you're dealing with an 800-pound gorilla, and effectively there's a security breach, and you're now trying to charge the gorilla for the security breach. So he is going to politically bust your chops as hard as he can.
All right. Now,
now, here's your recourse. You can sue the federal government. Good luck with that. And by the way, your legal costs are not allowable when you sue the federal government.
okay, can we?
So you see the 800-pound gorilla coming at you, right?
Yes, I do.
So
and
now
I've
if you're
already received it.
So now Yeah. So now if your policy was we maintain our security clearance for the entire benefit of the government, and we plan on proposing lots of different classified projects, it would become purview to your indirect rates which would be negotiated by DCAA. Now, the issue there would be these contracting officers have the right to call DCAA and say, hey, I want you to bust Tom's chops because he screwed me on my contract, and they will. And if you deliver something beautiful to them and it goes flawlessly, they'll pretty much leave you alone unless you're doing, stupid accounting things. So it's a very political process that you're involved in.
Okay.
Which is why I try to stick to accounting 101 and 102 here.
Okay. So this then is an indirect expense which adversely impacts our rates, not just for this contract, but for all others. Is there that grounds for a request for adjustment to the cost?
There are grounds, but you're in a very politically difficult situation. So remember back when I said to you, let's pretend I say to you, I'll do your personal tax return for $500 as long as I can control my overhead rate. And now I come back to you and I say, listen, I know that under the requirements of the contract, I have the right to bill you for my overhead rate variance. And I had a hard time controlling my overhead rates, Tom, so I'm charging you $800 instead of $500. Now, in theory, you were supposed to notify your customer when the job was 80% spent to let them know that you weren't going to have adequate funds, and you didn't do that. So technically, they're going to find a loophole to strangle you with, because I'm betting you that you didn't put them on notice.
Yes, I did, but then the breach
occurred.
Yes, but then the breach occurred.
I got to tell you, Tom, I'm happy to talk to you offline, but this is like way beyond the normal scope of a 101 intro conference.
All right. The only other last comment I would make is that you didn't bring up the limitation of funds clause in your explanation of this battle with the gorilla.
Oh, no, it's absolutely there. It's just a little bit more than the other 50 people in the audience can probably stomach. But yeah, I mean, you're dealing with an 800-pound gorilla. So anyway, I'm going to wish you luck. I'm happy to talk to you offline, and we'll see if anybody else has their hand up. All right, let's see. Somebody have an easy question? I could use a layup right now. All right, Anne Marie, are you there?
I am. Thank you. Thank you very much. I enjoyed this webinar. Can you use the word allocable or attributable as identical to direct when you're describing expenses? Like, is a direct expense an allocable expense, allocable to the project?
So you're trying to allocate your costs to the proper bucket is really what you're trying to do. Right?
Got it.
So you're going to allocate a cost as either a direct or an indirect or an unallowable expense.
Oh, got it. Okay. So the allocate is a more general verb. It doesn't necessarily mean allocating it to a direct project. It could be allocated to an indirect bucket.
It's going to be a case-by-case situation. So if you've got a lab jacket and you're cutting up cattle, your lab jacket may be a direct expense, but for most of my clients, it's going to be an indirect expense. So how do you allocate costs?
Excellent, thank you. How about attributable? Is that the same adjective as?
Yeah. I mean, don't trip yourself up in the fancy words that you're reading.
Got it. Okay.
I mean, that's why I'm trying to give you a layman's understanding of what all these technical terms mean.
Perfect.
All right.
Which I appreciate.
Good luck. All right.
Should I ask you my second question, or am I using up everybody's time?
Go for it.
If we have a consultant, he's under a subcontract, but we've put him under a firm fixed price basis. Does his invoice need to tell me how many hours he actually worked, or can he just say, I delivered deliverable 1, pay me for milestone 1?
Wow, so you just said something that confused me right off the bat. You said we have a consultant who's under a subcontract. So what does the legal agreement say? Who's the legal agreement with?
It's with us. So we execute a consulting agreement with him. We're paying him from
he's got a consulting agreement.
Yes,
he's not
with
a
us.
You're not subcontracting a large scope of the project to Johns Hopkins University. You're
Correct.
outsourcing a little task to a consultant.
To Bob Smith, yeah.
Right, so Bob Smith, you are required to have a written consulting agreement with an hourly rate and a detail of the scope of work he's going to provide, and he has to bill you and show you what he did and how many hours he did. Now, I'm going to give you an example. So you have to assume that a DCAA auditor thinks you're lying, and he assumes that Bob Smith is building an addition on your house. So how do I know Bob Smith isn't building an addition on your house? Oh, I have a consulting agreement right here. It says he's going to, test the horse for rabies, and here's the consulting agreement, and here's the bill for the rabies tests.
Mm-hmm.
So what the auditor cares about is the paper that you supply to them, not the story that you tell. And I'm feeling stories, and I don't want stories. I want a piece of paper, and I want my piece of paper to be nice and crisp, because that's what I sell an auditor. And that's why so many clients hire us, because we don't tell auditors stories. We hand them pieces of paper and they go away.
Exactly. But the consulting agreement is printed on paper, and it says, you'll do this work for me, test the horse for rabies, for $50. So when he says, here, here's the proof I test. Okay, well, I was thinking, I will do the job, deliver you this milestone, this deliverable, and you'll pay me for it. So I was going to say, you test the horse for 50. He says, here, I tested the horse. Give me 50. Okay. I don't make him put on his invoice, it took me 1 hour.
All right, so you've subcontracted to a consultant on a fixed price basis for his test. So was the test reasonably priced, and did he perform the work, and can you prove that he did the work?
Got it. Yeah, we go through our procurement justification per hour. Okay, sorry. Yep. So if we have a fixed price.
So you've really carved out a little task for a consultant.
Mm-hmm.
Okay. Yeah, sometimes the line between consultants and subcontractors isn't as clean as, the government would like it to be. So you got to start sniffing it and kicking the tires and making sure that, really just think about it like this. If whoever, was in charge of the project got hit by a car and all I had was a piece of paper, could I convince somebody that real work was done for a reasonable amount of money?
Mm-hmm. That makes sense. That's
right.
Hugely helpful.
Anyway,
yep.
I'm going to mute you if you've got any other questions. Cyrus, are you there?
I am. Thank you so much for the webinar is very helpful, and thanks for taking my question. Hopefully a quick one. Just regarding timesheets. So currently we just kind of do a bi-weekly timesheet where at the end of 2 weeks we just fill out all our hours and we get the signatures. And from what I heard today, that is bad. So how much trouble are we in, or how little trouble, and what should we do to correct that?
Well, I don't want to tell you that you're in trouble in front of an audience, first of all. So I've got the timekeeping policies that you have to have in front of me here. And what you're saying is not something that we don't see every day. What you want to make sure that you do is you remedy the problem as quickly as you can. So you just instruct your employees, listen, I need you to fill out your timesheet on a daily basis and hand it in every other week, and make sure that you sign off on it. Now, if the employee doesn't fill out the timesheet every day and you don't police it, you're probably not going to jail, Cyrus. But if DCAA comes out and finds out you're telling somebody to charge something while they're working on something else, that's a problem, right? So you have to look at this in terms of the magnitude of really what's going on, right? So basically what you said to me was my employees fill out their time cards for, like a 10 or 12-day period a couple of times a month. Now, I got to tell you, Cyrus, I don't know what I did yesterday. So if I didn't write it down, I'd be in trouble. Now, I'm also working on like 15 different things at a time. So if somebody's working on one thing all the time, it's not as big a problem. But when you've got more and more employees and more projects, it becomes a bigger and bigger problem. and there's more propensity to have problems. So, I mean, typically what we see that kind of becomes a problem is, oh, we don't keep timesheets, but I know Joe always works on project A. And then I say to my client, hey, can you have Joe fill out his timesheet? Oh, shit, we let Joe go 2 months ago. Now I got a real problem, right? So, I mean, you know, I'm not asking you to commit fraud by saying, hey, can you just remind your employees to do things this way? And you can you know, apply leniency or toughness as need be. But I will tell you, you know, it's funny. You start a company and it's you and another person and they're cool and you're cool and the next guy's cool and the fourth guy's cool and then the fifth guy isn't cool. And they're working 2,500 hours a year and you're not giving them the raise that they want and they're not getting, you know, the career advancement they want, and they feel slighted and they start pouncing on opportunities to have a problem. They're called disgruntled employees. So I don't wish it on anybody, and that's why I really want to make you aware of it. So good luck. I don't think you're going to jail, but you know, you need to take a little bit of simple corrective action, Cyrus. Good luck. All right, let's see what else we've got here. One more. Bill. I think I recognize this name. Bill, how are you?
Hi, great. Thank you for taking my call.
Sure.
One question. So real simple, if you could just differentiate a little bit between sub-awards and consultants. And the real question is, can we charge our overhead rate on the bills that our sub-awards and consultants give us? Or does that, or are we not allowed to do that?
Bill, I got to tell you, that's an incredibly simple question, believe it or not. If you set up your indirect rates and you tell the government, I'm going to take, so typically when we sit with clients, there are 5 common indirect rate methodologies. So if you're a Department of Defense contractor, we typically see they'll have an overhead rate, or they'll have an overhead and a G&A rate, or they'll have a fringe overhead and a G&A rate. If they're grantees, we typically see a fringe and an F&A rate, or a fringe and a modified F&A rate. So those are the 5 most common ways that people maintain their indirect rate structures, right? So depending on how you set up your indirect rate recovery system, the answer to that question becomes incredibly simple. So if you have a G&A rate typically gives you, let's say, a 12, 15, 25% G&A rate. So if your subcontractor bills you $100,000, you have the right to mark that up with your G&A rate of 15% or 25% or whatever that number may be. If you don't set up your accounting, your indirect rate recovery system that way, when the so let's say that you just have an overhead rate. The way an overhead rate works is you're charging all of your indirect rates and you're recovering them based on how employees charge their labor hours. Their labor hours convert to labor dollars, and those labor dollars are how you charge the government for all your overhead. So when a subcontractor, a material cost, a travel cost comes through your accounting system, you've already told the government, I don't want to recover any costs on that. I'm just going to recover all my indirect costs based on my labor. So typically, one of the most important things you need to do is set up your indirect cost recovery system correctly. So as an example, if I've got a software company, you know, envision 4 guys sitting in a room, they don't even turn the lights on because they're just sitting there banging code all day. They don't have a lot of travel, they don't have a lot of subcontracts, they don't have a lot of other direct costs. It's just guys banging code. It's great to have the simplest indirect cost recovery methodology that you can. So in that case, I would advise that company to have an overhead rate, right? Single pool, it's either direct or it's indirect, incredibly simple. When you start moving costs to subcontractors and consultants and it becomes more and more material, you're going to want to have a G&A rate if you're a DoD contractor or an F&A rate if you're a grantee. So, you know, if you go through the, I'll take you back to this for a minute. The very first thing that we do when you come through our phase 1 survival kit is understand what your business is going to look like from a technical perspective as well as a financial perspective, so that we can make sure that you set up the right indirect cost recovery system. If you have failed to do that, there are methods that you can go through to notify the federal government that you're going to change the way that you recover indirect costs that have to be approved. But it's not a fatal blow, but it's something, you know, that we see occasionally. I notice I'm way out of time. I was trying to get this done in an hour and I'm 10 minutes over budget. So I'm going to wrap it up. I'm going to thank everybody for coming out. Happy to talk to anybody off the side. If you want to give Ryan a call, he can schedule time with us. I'd like to thank everybody and wish you a great day. Thanks. Bye-bye.